And good afternoon from Oanda, Asia. Well, what's been driving the market so far this week? Well, it's one word: inflation. So last week, the non-farm payrolls had a massive miss to the downside. Should have been almost deflationary, not inflationary, because less people coming into the workforce. But that was actually moved past very quickly. And this week, all we've heard and all we've seen price action wise is concerns about inflation. Now, there's been a lot of noise this week and markets are chasing their tails back and forth. And it can be quite easy to get confused and wrapped up in that noise. But I think what we need to take out of this is the direction of travel for the markets. And the direction of travel, given that the non-farm payrolls was ignored so quickly, is that the markets are now concerned about rising inflation, be that because of supply chain constraints, semiconductors, rising commodities, rising food prices, labor shortages, wage expectations, yada, yada, yada. The direction of travel for the markets now is concerns about higher inflation. Now, we've seen some quite aggressive reactions in the market this week because of this, most notably in the equity space. And I think the reason we are seeing some of these choppy markets is because at the end of the day, we've had a 15-month bullish market from March 2020 last year in the depths of the COVID-19 pandemic shutdown, and it's gone one way without any material pullbacks that entire time. When we see markets like this, investors start getting very, very nervous at the top of these markets, and their propensity to hold even minor losses on pullbacks is very negative. And what we get is a lot of this toing and froing, choppy, fast money trading and some quite aggressive moves intraday. Having said that, though, there are some very interesting developments. And the first one I want to talk about is the Nasdaq, the tech-heavy Nasdaq. And it has actually finally broken out of its one-year uptrend line. This line you can see on the charts, it goes from bottom left to top right. It's in blue. It broke out of there at 13,400 on Monday. It also closed below its 100-day moving average. That's the little red line below it. And ever since then, it's struggled to reclaim that level. This is a very significant tech breakout. And when we think about the rally in technology stocks and the pimped up valuations that we're seeing around the world for them, markets are perhaps more vulnerable in that space to a pullback on higher interest rates / inflation concerns. My target for this pullback could extend all the way to 12,500, which is the little blue line halfway down, and that is the 200-day moving average. Quickly thinking about the S&P 500 and the Dow Jones, well, they're much more cyclical, heavy companies, and also more balanced. They're not so tech heavy. They are still well and truly in bullish markets, and the markets would have to fall between 5 and 8% before they ended up testing the one-year support line that we can see on the Nasdaq chart. We saw some ructions today as we turn to Asia and Taiwan, where markets fell nearly 8% intraday, and we can see the TAIEX up on the screen now. We can see some quite aggressive price action there. COVID-19 has returned to Taiwan, and also Taiwan is the largest producer of semiconductors in the world, and we all know about the semiconductor issues. If COVID-19 community cases keep increasing in Taiwan, that could put potentially production strains on these Taiwanese semiconductor producers because of potential social movement restrictions. That is going to be felt all around the world and could be another knife in the back of the global supply chain squeeze, and it won't be good for tech stocks either. We can see here that it broke support at 16,850 yesterday, and it is now closing below the 100-day moving average, that red line on the chart, at 15,900. I haven't got a target for this, but we need to monitor the TAIEX very closely over the next few days. Okay, so what is going to spur these moments on tonight? Well, let's watch the US CPI. A high print there is probably going to see more equity weakness. Thanks very much for tuning in, and we'll speak again next week.